This is the part 2 of the lecture on Introduction to the Evolution of the Concept of Income in Japanese Tax Law. Let's start from section 3 here. The history of Japan's income tax law began in 1887. The Income Tax Act, promulgated as Imperial Ordinance Number 5 of 1887, stated that anyone whose income from assets or business activities amounts to more than 300 yen annually shall pay income tax according to this act, thereby imposing income tax on individuals who earn income above a certain threshold. The Act adopted a progressive tax rate system divided into 5 brackets based on income levels, reminiscent of the class-based tax system of Prussia at that time. The 1887 Income Tax Act broadly included income from public bonds and deposits, dividends, salaries, and income from assets or business activities as taxable. However, along with military salary during service and travel expensive pensions for the wounded or sick soldiers and assistance for orphans and widows, it exempted temporary income not related to business activities from taxation. The exemption of temporary income not related to business activities meant that certain types of income were excluded from taxation compared to Japan's current income tax law. For example, retirement bonuses received as a lump sum were considered non-taxable. Additionally, profit from incidental activities that were not part of a business, such as capital gains from appreciating assets or profit from a temporary event, were broadly excluded from taxation. This exemption of temporary income not related to business activities continued for about 60 years as an important principle of Japanese income tax law until its abolition in November 1947. The Income Tax Act was fully revised in 1899, 1920, 1940, and March 1947 with some changes in expression, but the exemption remained in place. For instance, the 1940 Income Tax Act stipulated that income from temporary non-business related activities would not be subject to income tax. Similarly, the March 1947 Income Tax Act also excluded temporary income not derived from continuous business activities from taxation. In this way, the pre-war and early post-war Income Tax Act had more limited scope of taxable income compared to the comprehensive concept of income. The condition for exclusion from taxation was whether the income was temporary income not related to business activities. The scope of temporary income not related to profit-making businesses was gradually narrowed between 1887 and 1947. In other words, the range of income subject to taxation steadily expanded. At the same time, capital gains, that is the increase in value of individual assets that generate income, began to be included in taxable income at the time of asset transfer. Particularly, the aim was to tax capital gains that arose through wartime circumstances. On the other hand, bonuses, which are essentially compensation for labor, as well as other forms of temporary income, and income not derived from continuous activities aimed at earning income, came to be included in the scope of income tax. Regarding capital gains, the 1918 War Profit Tax Act made profits from the sale of ships, mining rights, and similar assets not included in business operations subject to taxation. Since this act was intended to tax extraordinary profits gained from World War I, it was abolished in 1919 following the signing of the Treaty of Versailles. The direct predecessor to the current treatment of capital gains is the 1939 revision of the Temporary Profit Tax Act, Article 3, Paragraph 1, Item 3 of the revised act added profits from the transfer of ships or rights and equipment related to mining or placer mining to the taxable items. The drafters explained that the purpose of this taxation was to recover part of the incidental profit resulting from the China incident through Later, the 1942 revision of the Temporary Profit Act expanded the scope of taxation to include real estate and rights related to it. The taxation of capital gains introduced through the Wartime Special Act was incorporated into the Income Tax Act after the end of World War II. Following the conclusion of the war, Japan faced an even greater need for funds than during the war due to inflation and post-war reconstruction. Given these circumstances, the 1946 revision of the Income Tax Act newly incorporated the taxation of individual transfer profit, previously regulated under the Temporary Profit Tax Act as taxation on capital gains. However, at that time, the Income Tax Act still upheld the principle of non-taxation for temporary income not arising from continuous activities aimed at profit-making. Therefore, the drafters explained that taxation on profit from the transfer of real estate and similar assets was to be treated as an exception. The scope of temporary income not related to profit-making businesses continued to narrow even beyond capital gains. Particularly significant was the 1938 revision of the Income Tax Act, which brought retirement allowances into the scope of income tax. Specifically, temporary pension or similar retirement allowance received in this country became taxable, with the amount subject to taxation being the total payment minus a 5,000 yen deduction. Regarding the intent of this legislation, the drafter explained. Previously, this was not taxed as temporary income, but those receiving substantial retirement allowance are generally from the middle or higher classes who have considerable financial capacity. Therefore, for retirement allowances exceeding 5,000 yen, a modest progressive rate is applied and the tax will be withheld as a source at the time of payment. As mentioned earlier, the complete revision of the Income Tax Act in March 1947 still excluded temporary income not arising from continuous profit-making activities from taxation. However, November of the same year, the Act was revised again, and taxation on such temporary income started. Specifically, Article 6, Item 5, concerning non-taxable income, was amended, and newly added Article 9, Paragraph 1, Item 8 defined temporary income as income other than those listed in the preceding items, which is temporary and not derived from continuous profit-making activities, making it subject to taxation. The current Income Tax Act, enacted in 1965, includes 9 types of income ranging from interest income to temporary income. In addition to these, it also covers miscellaneous income as taxable income under Article 35, Paragraph 1, defined as income that does not fall any of the following categories: interest income, dividend income, real estate income, business income, employment income, retirement income, forestry income, capital gain, or temporary income. Therefore, unless the income qualified as non-taxable income listed in Article 9 of the Income Tax Act, all types of income are subject to income tax. However, the term income as used in the Income Tax Act does not perfectly align with the income defined by the comprehensive concept of income mentioned earlier. While the comprehensive concept of income serves as a guideline for interpreting and legislating income tax law, the current act fails to incorporate certain types of income defined by this concept. This discrepancy is to some extent considered unavoidable. First, there is the issue of when to tax capital gains. According to the comprehensive concept of income, capital gains constitute an increase in net wealth and therefore income accrues as the value rises. However, under the current Income Tax Act, capital gains are in principle taxed as capital gains income only when they are realized. Here, realization refers to the act of definitely obtaining the previously latent increase in asset value in the form of money or other compensation by transferring the asset. That said, there are exceptions within the Income Tax Act where capital gains are taxed even before realization occurred. As a result, this treatment of capital gains under the Income Tax Act is subject to criticism from both sides. On one hand, from the perspective of strictly applying the comprehensive concept of income, it is undesirable that the act delays taxation until the capital gain is realized through a transfer. On the other hand, from the standpoint that emphasizes the actual acquisition of monetary value, realization should be a requirement for income, and it is inappropriate for the law to tax unrealized capital gains, even if only in exceptional cases, since they do not yet constitute income. Before examining the criticism mentioned above, let us first review the rules governing capital gains under the Income Tax Act. Article 33, paragraph 1 of the Income Tax Act defines capital gains income as income derived from the transfer of assets. Paragraph 3 of the same article outlines the basic mechanism for calculating the amount of capital gains income. It requires the deduction of the acquisition cost of the asset from the amount of revenue received through the transfer. Furthermore, Article 38, paragraph 1 clarified that the main component of the acquisition cost is the amount paid to acquire the asset. From these provisions, capital gains income essentially refer to the difference between the compensation received when selling an asset and the amount paid when purchasing it. If this difference is positive, it is subject to income tax as capital gains. In this way, capital gains income targets the increase in value of individual assets owned by a person at the time the person disposes of the asset. Unlike business income or employment income, which reflect a person's economic activity over the course of a single year, capital gains income aims to capture the changes in an individual's economic position in the long run. This is evident from Article 33, paragraph 3, which allows for the deduction of the acquisition cost from the amount of revenue received through asset transfer, and from the fact that the term amount of revenue refers to the monetary value received as compensation for the disposed asset. Although Article 36, paragraph 1 of the Income Tax Act merely defines the amount of revenue as the amount to be received in the relevant year, it is widely accepted that this refers in principle to the economic value received by an individual as compensation for asset transfers or the provision of services. From the standpoint of the comprehensive concept of income, it is desirable to tax capital gains as they arise. This would involve measuring changes in asset values annually and taxing any capital gains that have occurred. This method of taxation is known as the mark-to-market principle or fair market value taxation. While this approach is partially adopted in the Corporate Tax Act, it is not adopted in the Income Tax Act. Under the current Income Tax Act, capital gains are taxed at the time of transfer, which from the perspective of the comprehensive concept of income is considered too late. Moreover, among individuals who hold assets that have appreciated in value, only those who happen to transfer the asset are taxed, while others are not taxed at all, no matter how long they hold the assets. This is often criticized as being unfair. However, in practice, it is likely avoidable to tax only realized capital gains as a rule. Even Hiroshi Kaneko, a strong advocate for the idea that the comprehensive concept of income should underpin the Income Tax Act, acknowledges the following. Of course, identifying and evaluating unrealized gains is extremely difficult, and doing so would impose an excessive burden on both taxpayers and tax authorities. Furthermore, if unrealized gains were generally subject to taxation, the scope of taxation would become unclear, potentially destabilizing the legal position of taxpayers. Considering these issues, it is more appropriate as a matter of policy to continue taxing only realized gains as a rule. In contrast, taxing unrealized capital gains, even in very exceptional cases, has been strongly criticized by those who argue that only realized gains should be considered income. The state of debate differs significantly between Japan and the United States. In Japan, the Supreme Court's decision on October 31st, 1968, rejected a taxpayer's claim that the predecessor of Article 59 of the current Income Tax Act, which taxes unrealized capital gains, was unconstitutional. On the other hand, in the United States, although there were several provisions in the Internal Revenue Code that are considered taxing unrealized gains, Eisner versus Macomber, a 1920 Supreme Court decision, which clearly stated that realization is a constitutional requirement for income, has not yet been explicitly overturned by the court. Even in recent years, some conservative legal scholars have clearly stated that taxing unrealized gains through federal income tax is unconstitutional. As a result, it remains unclear whether taxing unrealized gains is constitutionally permissible in the United States. Article 59 of Japan's Income Tax Act is a provision that imposes tax on unrealized capital gains. Paragraph 1 of this article allows for the taxation of capital gain by deeming that a transfer of asset has occurred at fair market value, even when no actual transfer in exchange for consideration has taken place. This is referred to as a deemed sale. For example, if an individual donates a piece of land originally purchased for 10 million yen and now worth 15 million yen to a corporation. Article 59, paragraph 1 treats this as if the individual had sold the land for 15 million yen. As a result, the capital gain of 5 million yen is considered capital gains income and becomes subject to income tax. The deemed sales system was introduced in the 1950 amendment to the Income Tax Act, following the 1949 Sharpe recommendation. Regarding the purpose of this system, the Sharpe recommendation stated, "An important part of our recommendation concerning capital gains and losses is that when a capital asset is given away during life or at death, the gain or loss accrued on the property by that time must be taken into account in the income tax return of that year. This is essential to preventing the indefinite postponement of income tax through several generations." In other words, the Sharpe recommendation aimed to impose on capital gains accrued up to the point of asset transfer, regardless of whether the transfer was a sale or another form of transfer, such as a gift or inheritance. Although certain types of income are undoubtedly considered income under the comprehensive concept of income, they are treated differently from other types of income under the current Income Tax Act. Here, treated differently means that they are either not taxed at all or are taxed separately from other types of income at a lower rate. There are two main reasons for granting special treatment to some of these types of income. First, there are administrative considerations. The comprehensive concept of income ideally involves aggregating all income attributable to an individual and taxing it under a progressive tax rate. However, there are cases where even if income appears to exist, it is unclear to whom it belongs, or determining the owner of the income would incur enormous costs. For such types of income, comprehensive taxation is abandoned, and separate taxation through withholding at the source is employed. Second, there are policy considerations. Indeed, an income tax system based on the comprehensive concept of income generates substantial tax revenue and is desirable from the perspective of fairness among individuals. However, in order to achieve certain national policy goals, specific types of income may be given preferential tax treatment even at the expense of the comprehensiveness of income. Here I will introduce the historical changes in the treatment of capital gains from the transfer of securities such as stocks, which have been consistently received special treatment due to administrative and policy considerations, even after the comprehensive concept of income was adopted. As previously noted, the 1946 revision of the Income Tax Act incorporated capital gains into the scope of taxable income. However, at that time, capital gains from the transfer of securities were not included as taxable capital gains. Subsequently, in the complete revision of the Income Tax Act in March 1947, stocks were added to the category of assets that could generate capital gains. At that time, only half of the capital gains from asset transfer were included in the tax base for capital gains taxation. In contrast, the 1950 revision of the Income Tax Act following the 1949 Sharp recommendation changed the tax base to the full amount of capital gains rather than just half. Additionally, deemed sale taxation at the time of inheritance was introduced. From an administrative standpoint, it was not easy at that time to identify the true owners of securities such as stocks. Even securities companies which facilitate the trading of securities were not always able to determine who the actual parties to the transactions were. Additionally, there was strong opposition from the securities industry against the taxation of capital gains from securities transfers. Given this background, in 1952, the taxable base for capital gains was changed to the amount remaining after deducting 100,000 yen from the gains and the deemed sale taxation at the time of inheritance was abolished. Furthermore, in 1953, the taxation of capital gains from securities under the Income Tax Act was abolished. And instead, a new transactional tax called the Securities Transaction Tax was introduced. This tax was levied on the value of securities at the time of sale or other transactions, with the seller being the taxpayer. In other words, regardless of whether there was a gain or loss from the transaction, a fixed percentage of the transaction value was paid as tax. The abolition of income tax on capital gains from securities and the introduction of the securities transaction tax reflected the aforementioned administrative challenges and the demands of the securities industry. However, when proposing these reforms, the government explained that the abolition of income tax on capital gains from securities was a means to achieve the policy goal of promoting capital accumulation. Subsequently, in response to growing criticism over the extremely limited taxation of capital gains from securities, believed to be primarily earned by relatively wealthy individuals, the 1988 revision of the Income Tax Act removed income from the transfer of securities from category of non-taxable income. At the same time, a new system was introduced under Article 3710 and following of the Special Taxation Measures Act, allowing taxpayers to choose between separate self-assessment taxation and separate taxation through withholding for income from transfer of securities. Following further reforms, including the abolition of the securities transaction tax in 1999, the current system has become well established. In principle, separate self-assessment taxation applies, while the special account system serves as an exception. And many people, many investors, including me, use this separate taxation. This system allows for simplified filing or even exemption from filing, provided that tax is withheld at source. The tax rate for these forms of separate taxation is 20%, which is significantly lower than the maximum income tax rate of 55%. Therefore, the current system falls far short of the ideal envisioned by the comprehensive concept of income. Nevertheless, it is clear that capital gains from securities are now subject to income taxation to a certain extent. Okay, so this is the end of my lecture. Thank you very much for your attention.